Good morning, everyone, and welcome to the monthly economic briefing from the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Associate Rob Knapp, and we are happy to have you with us this morning. So last month, the Fed did something it hadn't done in a while. It did not raise interest rates. It was the first time that it happened since the February 2022 meeting. So what will happen this month? Well, the Fed has a lot of things to look at. One of them it will look at is the jobs number we got this morning. The jobs number did not come in hot as it has in some previous months, 209,000. So the Fed is going to have some decisions to make. In just a moment, our chief economist, Gerald Cohen, is going to join us. He's going to talk about that jobs number and some of the other employment numbers from the report this morning. He's also going to talk about the decisions facing the Fed and what they might do this month, if they're going to continue that don't raise the interest rate streak for another month, or if we're going to be back to business as usual as it's been lately. So Dr. Cohen will join us in a moment. He'll spend the first half of the briefing giving his analysis of these things. The second half of the briefing will turn over to your questions. We hope you have them ready. You can submit them at any time using the Q&A function at the bottom of the screen. You might not want to submit them too late. If we get too late in the briefing, we might not be able to fit them in. So keep an eye on that, please, but submit them anytime you want. If you are a member of the media, please include your title and organization, and we'll make sure to get your questions in. If you're joining us by phone today, you can also ask questions by sending me an email. I am at rob_knapp@kenan-flagler.unc.edu. We will try to get everything in. We'll usually wind this up about 9:30 Eastern. For those of you who have 10 o'clocks on the calendar, we'll get you there on time, but we will try to squeeze all the questions in if we can. I think that's everything I need to tell you. So without further ado, will you join me in welcoming our chief economist, Gerald Cohen, who's been working busily the last 30 minutes to figure all of this out and have a great presentation for you. Good morning, Gerald. It's good to see you.
Good morning, Rob. It's good to see you. It has been an interesting morning, and I'll say that that the data has been, I think, more mixed than what the data last night suggested or yesterday suggested. I think it's been, and I think that this is, I don't think that this is going to change the path for the Fed, at least for the next meeting. They've kind of said too much. The data is strong enough, but I think it does raise questions about the future. The number came in 209,000 for jobs, 3.6% for the unemployment rate. That's the unemployment rate was unchanged from May. The 209,000 was a bit less than expected, 21,000 less than expected. Expectations actually risen following yesterday's ADP and ISM numbers. And as I wrote in LinkedIn yesterday, that data came in very hot, and that data sometimes cannot be so accurate as the non-farm as the payroll data. And that's exactly what happened. I mean, that data suggested that this was going to potentially be a blowout number. And what I wrote in LinkedIn is, let's actually see what the real hard data looks like. And the real hard data, as I said, came in a bit less than expected. But more importantly, in my opinion, were the downward revisions to the previous months. On net, there were 110,000 fewer jobs created than we thought between April and May. And that trend is worrying to me, and I think, and worrying to others who watch this data closely. So something, and we've had a couple of months where, yes, the reports were strong. Last month was very strong, but then you've seen some downward revision. So that's something that, in terms of the dynamics, is worrying to me. And I think, as I said, may suggest not a change to what happens to the Fed going for this at the end of July, but may signal they're closer to done than we might than people had previously thought. I'm going to show you that in a second, how the markets are reacting. Average hourly earnings were strong, which is a worrying sign for the Fed that, we're getting this wage inflation, worried about pass-through of wage inflation to overall inflation. Hours were up a tad, but for the quarter, they were actually up they were up a healthy 1/10 in the number of weekly hours, 0.4% in total aggregate hours, the number of hours worked times the number of people. But for the quarter, it was actually not particularly strong, suggesting a modest, positive but modest GDP growth in the second quarter. And the participation rate was unchanged, but as you'll see, the fact is that we're in participation is back to its peaks in for prime age key workers, but we're still below peaks because of demographic factors, and I'm going to show that in a sec. So what I'm going to do now is I'm actually going to make the argument why the Fed is going to be raising rates after this pause, but I'm going to show you why I'm worried about the data going forward because of some of the signs that we've seen in the last few, even some of the signs that we saw in this data today, and then some of the signs in other data that we've seen. So let me just go through kind of show you, start with the Fed, the why the Fed is raising rates. So we had this healthy job growth. 209,000 is a really good number, but these downward revisions make me nervous. And we are seeing this slowing trend, as you can see in the orange line, which is the 3-month average. But if you drop me on, if it weren't for the fact that we had these downward revisions, and the fact that we are at 200,000 is still a very, very solid number. But as I suggested, the hours numbers suggest modest growth in GDP in the second quarter. And that was after upward revisions in the previous quarter, and I'll talk a little bit about that in a second. So one of the reasons why the Fed is raising rates is because not only have we surpassed the peak in employment, but we're almost aligned with where job growth should have been if we continued to have the pre-COVID trend. So the dotted line is the pre-COVID trend from February of 2020. And basically that's essentially 4 million jobs created since February 2020. And guess what? We're right about there, a couple 100,000 short of that. But that means that effectively we've come back from COVID and we're back to that trend. And that means and February 2020, the labor market was quite tight. So we're kind of back to the tight levels of the labor market that we saw pre-COVID. There are sectors such as state and local employment and such as leisure and hospitality, most notably, that are nowhere near the trend and haven't even gotten back to pre-COVID peaks. But other job creation mainly in services have come back to information services, things like tech have well surpassed pre-COVID peaks and even some of this trend. So this means the labor market is hot and tight, and that's one of the reasons why the Fed raised rates so much and will continue to raise rates. As I mentioned, the unemployment rate sits at a 50-year low of 3.6%. And we can debate about, people leaving the labor market, coming back in, not coming back in. But as a single measure of the tightness of the labor market, this is a pretty good one. And as I mentioned, the problem is that our prime age workers, so 25 to 54-year-olds are the demographics that are most likely to work. And we've now surpassed the pre-COVID labor force participation rate. So with women dominating that, but both men and women in that age group are kind of back to the levels that we saw pre-COVID. Men have had this, it's a 90% of men roughly 90% of men who are 25 to 54 are working. About 75 to 80% of women in that demographic are working. If you want to get more people into the labor market, you can do, one is to increase, to change policies that have more women in the labor market. And Sweden has a rate that's about 10 percentage points higher than US rates. But those are policies that really are only going to have long-term impacts. And so it's not like you can flip that switch quickly. The thing that we're seeing, though, that's not back to COVID levels is the overall labor force participation rate. And that's because of demographic factors. So more and more people are leaving are aging. As you move beyond that 25 to 54 prime worker prime age, you're seeing you're less likely to be in the labor force, and so demographics are weighing on our labor force participation rate. That's something that unless we change these policies are kind of immutable. But there have also been retirement choices post-COVID where people are saying, look, I'm kind of leaving the labor market. I've changed my view on work, and that has affected it as well. So the two things that we can long-term move the needle on is to change that, to incentivize older people to come back into the labor market or continue to work after their 54, 65 retirement ages. And the other one is more women. But these things are not something that that are going to change immediately. So all of this, so the point is that the labor market is another indication that the labor market is very tight, which is why the Fed is likely to raise rates. Now, inflation, which is the big boogeyman of the Fed, is the headline numbers have come down, and people are saying, look, the Fed is done or close to done. They're coming down. What I'm illustrating here is the PCE inflation rate, which is what the Fed's preferred inflation rate. And I'm showing you the 3-month, 6-month, and year-over-year changes just to show the different dynamics, and they're all headed lower. And so the Fed's target on this is 2%. So you could say, great, this is a great sign. But if you exclude food and energy prices, which drove some of that big increase and has driven the vast majority of the big decrease, you're seeing inflation stubbornly stuck at around 4%. And again, all of the dynamics, what's happening in the last year, what's happening in the last 3 months. So it's not just, previous, 8 months ago, we had some inflation and we're now seeing some abatement. That's not what these 3, the blue line, and 6, the orange line data is suggesting. So this is why the Fed is saying, look, we still need to raise rates, because if food and energy prices stop falling, we're going to end up with this 4% inflation rate. And so inflation is going to look like it's heading back up on an overall level. And then that's going to affect people's views on inflation and could embed inflation, high levels of inflation, back into people's thought processes. And that's why the Fed is so focused on this core inflation, on these inflation numbers, and on the tightness of the labor market. So we have created a number of models where we're saying, what is the Fed going to do? And this blue line, which is our Taylor rule estimate, suggests that the Fed is close to being done, but still has a little bit more to do. This gap between the orange line and the blue line is about 0.5 percentage point, which is what the Fed in its own forecast, which is the green line, is saying they're going to do by year end. So our model, the Fed's own estimate, is saying 0.5 percentage point up, and then we're going to start cutting rates next year. There are 2 key assumptions to this. We're taking the Fed's own economic forecast, and you can agree or disagree with that, and putting that into this model. And so both models are assuming that the Fed is right, and their forecast, as you'll see in a moment, is for inflation to come down quite sharply. And then the other question is, are past mistakes forgiven? So the Fed raised rates too slowly, as you can, versus our model, and they should have raised rates more. And so are we still seeing is the tightness in the labor market that we're seeing a result of these past, and the high inflation as a result of these past mistakes? And should they be tighter for longer? All important questions. As I said, these models, and I would say the Fed's own estimate, is based on their inflation forecast, which is, as you can see, that inflation is going to come down quite quickly. This is the core inflation rate that I'm modeling and their expectations of the core. So we're at this roughly 4%. We have come down, but are we going to come down as quickly as we expect and then end up at the 2% rate that the Fed wants? So again, that remains to be seen. Finally, I just want, as the headline said, the Fed is back in play. A month ago, and that's this light blue, the lightest blue bars are what the markets expected for the Fed the Fed funds rate to be at year end. And currently the Fed funds rate is between 5 and 5.25. And the markets were saying the Fed is most likely to ease rates by year end. This was a month ago. Now the markets are saying today, which is the darkest blue line, the Feds are expected to raise rates by the end of the year. And with one rate hike, very high probability, and then two potentially priced in. And what's notable is how this dark blue line even changed from yesterday. So yesterday, the markets were pricing in a higher probability of 2 rate hikes following the strong ADP and ISM data. And now they're pulling back and saying, definitely 1, 2, less clear. And that's, I'd say, where I am at, because based on the data that we have in hand. So let me show you why I think this data is worrying to me, besides the downward revisions. So I know I've said this before, but it bears repeating. Temporary help is one of my favorite leading indicators. Temp help jobs are the first to be hired and the first to be fired. And as you can see, in the previous 2 recessions, they kind of bottomed out right when the recessions ended. The gray lines are the recessions, and then started to pick up. And they generally started to fall a bit in advance of the recession in both cases. Basic temp help jobs peaked last year, and we're seeing kind of a steady downtrend. Interestingly, if I showed you this graph yesterday, it was more like a kind of a leveling off, but the last month we saw a decline of 13,000. We've actually seen some downward revisions in this data. So I've been saying, is this a labor shortage and you just can't get temp help jobs, or is this an indicator of a slowdown? I think that's, as I've been saying, I've been predicting a recession in the second half of the year, late 2024. Late 2023, early 2024. To me, this data is suggestive of some slowing, but the data continues to be, the data has been hot enough that you keep kind of pushing out where in the second half of the year. So as I said, late 2023, I'm still, in my opinion, we're still on the path for that. But if we continue to get 200,000 jobs, I'll keep pushing it out. But this temp help data is suggestive of some weakening. The other thing is jobless claims. We get this every week, and these have been trending up. There's some question about whether there's some false claims in Ohio, but there's always some questions about the data. I just think that this upward trend, it's still modest, is suggestive of slowing in the labor market, which is consistent with the data that we saw today. And finally, everybody talks about GDP. We tend to focus on GDP. It was up 2% in the first quarter, revised higher. People are saying, look, no recession. But there's another measure called gross domestic income, GDI. And there are two measures of GDP. And that, interestingly, that is contracted in the last 2 quarters. I'm not saying this is indicative of a recession. I do not think we were in a recession. I said this very strongly early last year. I don't think we're in a recession now, but maybe the economy is not as hot as the data is suggesting. So these are the reasons why I think the Fed, or among many reasons why I think the Fed is potentially has one more and then may stop. But they're very data dependent. So a month from now, let's look at what the employment report says, what all the data is suggesting. But I think we're close to being done, in my opinion. So let me stop and open it up to questions.
All right, very good. Covered a lot of ground. That may be a record for one of these, and the amount of ground we covered in that time. But as you said, there are a lot of mixed signals, and it's good to keep track of all of them if we're going to get the real picture. We do have some questions lining up, so I won't beg for questions, but if you do have one that you haven't given us and you want to get it in, hit the Q&A function at the bottom of your screen. You can email it to me if you're on the phone, rob_knapp@kenan-flagler.unc.edu. To the questions, and I'm going to start with one that actually kind of started where you did, and it concerns reconciling the number that we saw this morning with the ADP numbers we saw yesterday. Dan Barkin from Business North Carolina said, I know that ADP and DOL sometimes diverge because of their different methodologies, but this is a very large difference. And I wonder what might be some of the other reasons. Is there something about changes in the economy that is making job metrics less accurate?
So Dan, I think it's a great question. So one of the challenges with ADP is that they represent, roughly a quarter of, they do payrolls for roughly, I think it's, 25 million jobs. I think it's a very large, it might be a sixth of all payrolls. And they've been working hard. Neela Richardson, their new chief economist, has been working very hard to kind of make their data more accurate and representative of what's going on in the economy. The problem is that what people put on their like how people manage their payrolls or firms manage their payrolls can be different from what the number of jobs that are out there. So as an example, if you leave your company, are you the company, especially if it's a small business, and when I work for small businesses, I ask this question, the small business may not take you off of their payrolls until for several months, or you may be getting some bonus payments, you may be getting some severance payments or a bonus payment that keeps you on their payrolls, and that would be measured by the ADP as somebody who has a job, but people tend to kind of stay on these payrolls for a while after they've been let go, either because the firm just doesn't take them off, or because the firm, is paying out some severance or potentially a bonus or things like that. And so that makes what the ADP very challenging. When I talk to people who have dug into this data, they say, yeah, it would seem like it should be great, but it's more challenging. Now, another argument could be that this is the first cut of, and Neela will argue, well, we actually may be closer to the ultimate the ultimate number, because this is the first cut for the payrolls. And as I've been discussing ad nauseum today, that there can be significant revisions. So in a month, if we see a significant upward revision, then I'll say, look, the ADP was closer to right. But my research, and I've done on the ADP, is suggestive that I'm skeptical. Neela has changed. They've been working to change their methodology to be more accurate, but I want to see more months of data, and this data is suggestive that they're not there yet.
Okay, great. Thank you. Here's kind of a big picture question from Peter Pignataro. He talks about how the typical signs of a pending recession, inverted yield curve, 2 quarters of negative GDP, didn't really forewarn a recession. Now the yield on a 10-year U.S. Treasury note surpassed the rate of inflation for the first time in more than 3 years. So his question is, how and when did our economy change? Are the markets telling us anything about corporate earnings or anything about the economy, or is it just a sentiment and momentum-driven market?
So I'm going to push back on a couple of things, Peter, that you said. So the first is on the yield curve. As you know, if you've heard me, you've seen me talk about this in previous months. The yield curve, especially in particular, the spread between 10-year treasuries and 3-month treasuries is my favorite economic indicator. That curve inverted late last year, and that's when I called a recession. When it inverted between 10 years and 2 years in the middle of last year, maybe even in the spring of last year. And people were saying, oh, this is a sign of a recession. I'm saying, nope, it's not the right curve. The 10-year 3-month is the right curve. Now, what I said last year is that there's a lag of roughly 12 to 18 months between when that curve inverts, the 10-year 3-month, and when there's a recession, which is why I said last year, in the second half of the year, late 2023, early 2024. While I fully acknowledge that the data has not come in to be consistent with that forecast, forget about all the revisions, forget about the temp help. 200,000 is a strong enough number to say we are not in a recession, and the likelihood that we go into a recession next month and the month after, and I wrote something about this a few months ago, is very low. So we are unlikely to be in a recession anytime soon. But if these increase in jobless claims, if this temp help number is indicative, maybe in 6 months, maybe in 12 months, which would make the yield curve consistent with which would make the yield curve right. Perhaps market dynamics have changed, but the yield curve has been right every time since the mid-1960s. And in 2019, the yield curve predicted a recession. I predicted a recession. We had a recession. Yes, it did not predict COVID, but it's been right. And I'm happy to discuss more details about that. In terms of 2 negative quarters, sorry, my watch is, in terms of 2 negative quarters, that's never been a recession signal for the United States. And because of the employment dynamics, we never believed it was a recession. It had to do with productivity. It had to do with post-COVID recovery. Again, happy to talk about that more, but I fear I've answered only 2 questions in 8 minutes. So let me open it up to more.
Okay, and thanks for the question, Peter. I did a very quick paraphrase on you, so sorry if I lost anything in translation, but I know Gerald hit a lot of high points there. A couple of questions about some other things that are in the news and relate to this. Kenneth Hunter and another attendee asked about student loan payments and if the Supreme Court decision will bring a downward pressure on wage growth or any other effects that might have.
So it's an interesting question, because one of the things that goes into spending is your view of what your future assets and liabilities are. And so the fact that they've removed, the fact that students or student debt is likely to be now 10 or 20,000. It was not clear exactly what, but $10,000 or $20,000 higher is going to affect people's thoughts on their spending patterns. And so, yes, it's likely to weaken the economy somewhat. I don't think it's big enough. It's not big enough to move us into a recession, but it definitely moves the needle a little bit to the negative for students who have or former students who have these levels of debt. Remember, though, and this is why I'm saying the needle is pretty low, is that $10,000 or $20,000 is a meaningful number for people, but it's relative to your long-term path of income, and relative to what if you bought a house on with a mortgage, these numbers are relatively low, but they definitely will put a little damper on spending, and more of a damper for people who have these levels of debt.
Okay, good. Thank you. Let's see. This one is from David Hill of Triad Business Journal. What's behind the decline in manufacturing jobs? Weakness ahead, over inventory, something else?
I think that's I would say you, in some respects, answered the question. There has been, there was a big ramp up in manufacturing because demand for goods was very high, kind of during COVID, post-COVID. Finally, manufacturing has ramped up to meet that demand. In some cases, there's still shortages in some cases. And so now you're starting to see some, inventories that have been built up. And so, so that's why, one of the reasons why you're seeing a slowdown in manufacturing. And in some respects, this inventory number is a big driver of the cycles in manufacturing. When you see these inventories being built up, you then say manufacturing slows, and that is another sign of a potential recession when you see big inventory builds. It's hard to know because demand has been, the kind of post-COVID demand is much harder to measure because of the pent-up demand that we've seen, and even though it's 3+ years from the peak of COVID, we're still seeing a lot of that. And we do have very high levels of savings from COVID that is being drawn down, but they're still there. And that's one of the reasons why, consumer spending, in my opinion, is holding up, but also strong job growth. In some respects, that's more important. And one of the reasons why, when I put expecting recession, I expect it to be mild because of those high levels of savings. So I wish I knew the answer, but I think in some respects you've answered it. It's a combination of the inventories and potentially slowing and generally slowing demand, and potentially thinking about expectations for the future.
Okay. All right. One more. You ready?
Yep.
Has a rebound in immigration helped our labor market recovery?
Without a doubt. And this is something that if I could wave a magic wand to improve the labor market, and thank you for asking this question, because I didn't talk about immigration when I was talking about the challenges in the labor market. That would be the best way to loosen the labor market, is to have more immigrants. And I will put a note in that in a month and a half, or maybe close to 2 months, the Kenan Institute is having Tara Watson, who is an expert on immigration and one of our distinguished fellows for 2023 in our Workforce Disrupted Grand Challenge, is coming into Chapel Hill to talk about immigration. And she's going to talk about, both what's the right policies that are in the feasible set of politics. So I think it is definitely a needed safety or needed pressure valve for the labor market. And we are seeing a pickup in immigration. And so to me, that is a really positive. And remember, and as we said, as a colleague of ours wrote in an insight a number of months ago, immigration is good for the labor market. It is also good for innovation in our economy. Many of the immigrants come and they're highly skilled, and they help create startups, or they help build startups. And what we've seen is unfortunately some of the immigration policies around green cards, and that you have to hold a job, mean that sometimes there's been less innovation because of that. And so again, an insight that we'll send out today, but highly recommend in terms of immigration. So thank you for that question.
Yes, great question and great answer. And thank you to Dr. Gerald Cohen, as always, for supplying a lot of insight in a very small amount of time. plus including a plug for our coming Kenan Fellows speakers, our events. So a gold star from the external affairs team for you too today. Thank you very much. Great as always. Thanks to everybody out there for your questions. You gave us a bunch. There are a few we did not get to, and we apologize, but we call this a briefing, so we kind of have to keep it brief. But we do appreciate it, as we always do. It helps make this go. We wanted to let everybody with us in the media know that if you have other questions, if you want to connect with us in any way or continue the conversation, we'd love to do that. Please reach out to me if you'd like to speak to Dr. Cohen or any of our other experts about the Fed, the jobs numbers, or just about anything else that's within the breadth of our expertise. We're happy to help. You can email me at rob_knapp@kenan-flagler.unc.edu. For everybody that's on here today, we hope you'll go to our website at kenaninstitute.unc.edu. That will give you a look at the breadth of things that we have going on. And we also have an events calendar on there that will tell you when all of our Kenan Fellows that are scheduled to come in the fall will be here in August and September. So please take a look at that. That is everything we have for you today. We will be back on August 4th, I believe, when the next employment report comes out. We will be here to talk about it, and we hope you will be here with us. Thanks very much for everything. Glad you were here. Enjoy your Friday.